Hello and welcome to Hardman Talks. I'm Larissa Adams and I'm here with Hardman & Co.'s CEO, Keith Hiscock. Hi, Keith. Good to catch
Hi
up
there.
with you. Hi. Okay, so Keith, you have just published a paper entitled Labour's First Budget, Investors in Its Sights. So why is this one in particular so important for investors?
Well, I guess the first thing to say is that budgets are always important for investors because it gives a clue of about the government strategy, macro strategy. It gives you some data about how things are going, and it talks about tax changes. The reason this one's so important is it's the first Labour government budget in 14 years. It's they've talked about there being a black hole in the finances of 22 billion. People argue about whether that's just a made up number, but that's what they're hanging on. They've already ruled out changes, broad changes in more than half the tax base in income tax, national insurance, VAT, corporation tax. So that means that the bit that they haven't ruled out is going to suffer even more. And those are many of those measures are taxes that affect investors. And I think many Labour supporters will see this as a chance to even up the playing field and make those with the broadest shoulders bear more of the burden, I guess is the way they'd portray it. What this paper from us does is really focus on tax rates and tax concessions rather than look at the macro impact on investment markets.
Okay, so how should we go about judging what they might do?
Well, in this paper, we've applied four critical tests, as we call them. The first is this measure going to increase the tax raise, which allegedly is one of the things they want to do? Secondly, will it help grow the economy? And they've said, we're committed to growth. Will only the rich suffer? And how complex will these changes be to affect? Now, of course, no increases in taxes or reduced relief are likely to encourage growth in the economy. So that aim isn't really going to be impacted by some of these changes, except negatively. But I think it's also worth bearing in mind that many of the measures that it would appear are being contemplated would raise very little additional revenue, at least in the short term. And some of the measures are likely to negatively impact the liquidity in company shares, make more funds more attractive than company shares, and possibly make it more difficult for growth companies to raise cash in the equity market.
That's something to think about. So there's a lot of talk about changes on pensions. What could these changes be exactly?
Well, there are lots of things they could do. I think the two broad areas that are being considered are a change in the tax relief on contributions. At the moment, you get tax relief at your highest rate of income tax. So some people are getting 45% tax relief, others are only getting 20. So there's a call to say, let's just make it the same for everybody, 20% tax relief. Now, that would instantly generate quite substantial tax revenues. You could argue only the rich are going to suffer, and it's a relatively simple measure. The second broad area I think that's likely to be looked at is a restriction on the amount of tax-free cash you can take after the age of 55. It's broadly 25% of your lifetime allowance. For some people, that can be hundreds of thousands of pounds. So you might, for example, restrict it to a maximum of £100,000. That will have a pretty quick effect on tax revenues positively. You could argue it's only the rich that suffer. The complication with it, though, is that some people's financial planning is based around that. So, around getting that tax-free lump sum. So, for example, they might be relying upon it to pay off their mortgage. What would happen if they don't get access to that money?
Yeah. And what about capital gains tax?
Well, there've been quite a lot of measures on capital gains tax in the last few years anyway. Back in 2022, 23, the tax-free allowance, the amount of gain you could make before paying any tax was £12,300. And the Conservative government has brought it down to £3,000 in this tax year. So there's a big impact from that already. But there's an argument being put around that tax rates should be aligned between income tax and capital gains tax. Otherwise, there's an incentive to switch income into capital gains, which is possible in some cases. It's quite complex to achieve. It could end up being a tax on inflation. The capital gain has simply come from inflation. Is that fair? It's obviously a disincentive to invest in some respects. We also talk about the fact that it would probably benefit funds to the detriment of individual companies, because it's easier to manage your disposals and when you might pay capital gains tax. That's bad for liquidity in individual companies, makes it more difficult for them to raise money. There are some quite complex things you need to do in order to complete the return. Lots of people have lost the documentation, so that's a bit of a problem. It's probably going to encourage, if these changes come about, encourage investment in things where capital gains tax isn't payable: government bonds, personal possessions, gambling. So, for example, contracts for differences rather than shares. So, not quite sure that's so great. Our key test: is it going to raise extra tax revenue? Probably some. Will only the rich pay? That's probably true. Is it simple or complex? I think it's at the complex end of the scale.
And do you think there'll be other measures involving inheritance tax?
Lots of talk around here. There's talk around CGT being charged at death. That were to happen, I guess some people are going to change their investment policy away from listed shares towards the end of their life. Impact there again on the ease of companies raising money and liquidity. There's talk around the AIM IHT relief going. So at the moment, for most AIM shares, if you hold them for 2 years or more, they fall outside their estate. Again, if that were to go, you'd see a reduction in liquidity in individual shares. It would make it more difficult for companies to raise cash. And AIM has been a tremendous success story. AIM has raised huge sums of money for lots and lots of companies, and some really good companies that have come through it. And the relief recognises the fact that many of these are quite early stage companies and quite risky investments. So would it raise cash, these changes? It probably would over time, not immediately, because it might actually reduce the number of transactions instantly, because people will wait for a change in government and maybe a rollback of the new rules. It's certainly complex.
Yeah. And what about ISAs? Do you think we'll see some changes in ISA rules as well?
Well, ISAs is another area, another policy that's been very successful. There's £750 billion invested in ISAs, 450 billion odd in stocks and shares ISAs. But some people have now got ISAs with more than £1 million in, and the government's saying, or the Labour Party is saying, is this right? Should there be some kind of cap? It's quite complex to have a cap. Is it a cap on the contributions if you go over a certain level? Is it a cap on the size of the fund that's free of tax? When's it tested? It's really quite complex. I think the key outcome is, if you make them less attractive, there will be less interest in shares, British companies. That's going to lead to less liquidity in those companies and make it harder for them to raise money.
Okay, I think let's end off by talking about the tax enhanced schemes like EIS, SEIS and VCT. How are they going to be affected?
Well, this might be the one area that actually benefits from Labour's changes. There's cross-party support for these schemes, and that's evidenced in two ways. So first of all, the sunset clause for EIS was extended by 10 years. That means they were going to end in 2025. That's now been extended to 2035. And the Labour Party itself put a pamphlet out nearly a couple of years ago with a foreword by Rachel Reeves, the new Chancellor, that talks about the benefits of these schemes for the economy. So I don't think there are going to be any changes here, which means that people are probably, if all the changes we've talked about before come into effect, people might be saving less in ISAs, they might be saving less in their pension schemes, and EIS, SEIS and VCTs might be more attractive by comparison. But there's an additional advantage, which is that in some of these schemes, EIS, SEIS, you can delay the payment of CGT. You can effectively roll it over into the scheme, and that enables you to manage the timing of when you take a gain. So actually, these might be a real beneficiary of the next budget.
All right, thanks so much, Keith. That was great. If you're interested in reading Keith's full note on the budget, head over to our website. We've got the link in the description below. Otherwise, please do like, comment, and share our video wherever you're watching from, and we'll see you back here on Hardman Talks next time. Thanks so much.